Welcome back, everybody, to Sip and Talk.
Hey there. Great to be back with you all. Last time we got into Micky's thoughts on gold. That was pretty interesting, actually.
It really was a bit of a shiny discussion. And our friend Micky, the guy with those great notes, he's given us another one to chew on.
Yep.
Today, we're shifting gears, going a bit more digital, but just as exciting, I think. It's a head-to-head comparison right from Micky's investment thinking.
That's right. We've mentioned XLK before on the show, the big tech ETF. It's one of Micky's main holdings. But now he's thrown another name into the ring, IGV. It's focused on software, cybersecurity, and he kind of suggests it might be ready to give XLK a run for its money.
Ooh, a challenger appears.
Yeah.
So for all of you out there trying to figure out, where the tech world is heading, maybe where to place your bets, well, buckle up. We're going to compare these two tech titans based on Micky's notes. Look at recent performance, long-term stuff, and what makes them tick in different economic weather.
Okay, let's do it. The tale of the tape, maybe. XLK versus IGV.
I like it. All right, first up, XLK. That's the Technology Select Sector SPDR Fund for the official name. This one's the old hand, right? Launched way back in 1998. It covers, well, pretty much the whole tech landscape. IT services, wireless, chips, semiconductors, the whole buffet.
Yeah, the whole buffet is a good way to put it. It's like a huge established tech conglomerate, fingers in lots of different tech pies, diversified.
Exactly. Now compare that to IGV. That's the iShares Expanded Tech Software Sector ETF.
Right, and this one's quite a bit different. It's newer, launched 2001, and it really zooms in. It's focused specifically on North American software companies. Think application software, system software, even interactive home entertainment stuff.
So if XLK is the big tech buffet.
And IGV is more like a specialized software shop, like a boutique focusing only on software, very specific niche.
Gotcha. Okay, performance. How have they actually been doing lately? Let's talk about the sprint, the recent stuff. Micky's notes here are pretty clear. In the last year, IGV has, it's kind of blown XLK out of the water.
Yeah, the numbers are kind of stark. IGV's one-year return, 25.24%.
25%.
And XLK?
5.86%.
Wow. Okay, that's a huge gap over just 12 months.
It really is. And even just looking year to date. So since the start of this year, IGV is still a bit ahead. It's 6.243% versus 4.812% for XLK.
So why the big difference recently? What's Micky pointing to?
Well, it seems to tie right into all the buzz around, AI, cloud computing, that sort of thing. Software is really driving a lot of that innovation. Businesses are rushing to adopt AI, move more stuff to the cloud, and that means huge demand for software products and services.
Right, makes sense. That's where the heat is right now.
Exactly.
But okay, 1 year is just 1 year. What about the long game, the marathon, not the sprint?
Good question. And yeah, Micky's notes look at this too. If you pull back and look at the 5-year annualized returns, the picture flips.
It does.
Yeah, XLK comes out clearly ahead over 5 years. It's showing a 19.66% annualized return.
Okay, almost 20% per year for 5 years. That's solid.
Yeah.
And IGV? IGV is lower at 13.54% annualized over the same 5 years.
So XLK showing more long-term muscle and stability.
Seems that way. It's interesting. The 3-year numbers are actually much closer. IGV is slightly ahead there, 26.07% versus 25.56% for XLK. So a bit noisy maybe in the medium term.
But that 5-year view really highlights XLK's consistency, maybe because it's more spread out across different tech areas.
Could be. It definitely suggests more stability over that longer time frame compared to the more focused, maybe more volatile software bet with IGV.
Okay, and there's something else that really matters for long-term investing. The hidden costs. Fees. Expense ratios.
Ah, yes. Yeah. The silent portfolio killer if you're not careful.
Right. And Micky's notes really flag this. This is where XLK really shines, especially if you're holding for years.
And what are the numbers?
XLK's expense ratio is tiny. It's just 0.49%.
Wow, okay. That's super low for an ETF.
It is. And IGV, it's quite a bit higher at 0.41%.
0.41. Okay. Still not outrageously high compared to some mutual funds, maybe, but definitely a noticeable difference compared to XLK.
For sure. And Micky put it into perspective, right? If you invest $10,000.
Yeah, he did. Over 10 years, that difference between 0.09% and 0.41%, it adds up. You'd pay about $320 more in fees just for holding IGV instead of XLK, assuming the same returns before fees.
$300 just gone to fees. over 10 years on 10 grand. Imagine on a bigger investment, or over 20 or 30 years.
Exactly. Those low fees are a massive advantage for long-term buy and hold type investing. It's free performance, basically, just by choosing the lower cost option.
Good point. Okay, one more structural thing. Holdings and diversification. This one surprised me a bit.
Oh, yeah. How so?
Well, IGV actually holds more individual stocks than XLK. It's got 116 holdings.
Okay. And XLK.
Only 71.
Huh. So more stocks in IGV. You'd think that means more diversified.
Right. That's what I thought. But Micky's point is, it's about what those stocks are. Even though IGV has more lines on its roster, they're all playing the same position, basically. They're all software or software-related companies.
Ah, okay. So it's concentrated diversification, if that makes sense. Lots of names, but all within that one specific software sector.
Exactly. Which means if the whole software sector takes a hit, well, IGV could feel it much more sharply.
Whereas XLK, even with fewer holdings, those 71 stocks are spread across, hardware, software, services, semiconductors, a wider range of tech sub-industries.
So arguably, XLK might be less risky from a sector concentration standpoint, even with fewer stocks, different kind of diversification.
Makes sense. Okay, so we've got the numbers, the fees, the structure. Let's maybe zoom out now. What are the big economic forces, the tailwinds and headwinds that Micky sees affecting these? Specifically, when does software, and therefore IGV, really tend to fly high?
Right. When are the good times for software? Well, the biggest one, Micky notes, is just strong demand for digital transformation.
Okay, what does that look like?
Think about businesses wanting to upgrade everything. Moving to the cloud, adopting AI tools, using more software as a service, SaaS platforms.
It's like Zoom during the pandemic. Everyone needed it, like overnight.
Exactly. That was a massive boom.
Yeah.
Or companies like Microsoft with Azure and Office 365, or Adobe with its Creative Cloud. They thrive when businesses are spending big on upgrading their tech stack.
Got it. So heavy business investment in tech is key. What else?
Low interest rates. This is a big one for growth sectors like software.
Right, because a lot of these software companies are still in high growth mode, maybe not hugely profitable yet, and they rely on borrowing money for R&D, expansion, hiring.
Precisely. When interest rates are low, money is cheap. It's easier for them to fund that growth, develop the next big thing, acquire competitors.
And it also helps their stock valuations, right? Because future potential earnings look more valuable today when the discount rate tied to interest rates is low.
You got it. It's like getting a super cheap loan to turbocharge your lemonade stand expansion. You can grow way faster.
Yeah, okay. Makes sense. Anything else driving software?
Well, the obvious one right now, AI hype. And, real AI innovation, too.
Yeah, can't ignore that.
When there's this huge buzz around AI, machine learning, cloud infrastructure, software is right at the heart of it.
And that's definitely happening now in 2025. It helps explain that strong recent run for IGV we talked about.
Absolutely. Everyone wants a piece of the AI action. And finally, just a generally stable or recovering economy.
Makes sense. When the economy's doing okay or getting better, businesses feel more confident.
Yeah, they loosen the purse strings, invest in IT to become more efficient, more competitive. They're not just trying to survive, they're trying to grow.
Okay, so strong business spending, low rates, tech hype, and a decent economy. Those are the glory days for software and potentially IGV.
Right. But Micky's notes also covered the flip side. When might things get tough for software? And when might the broader XLK be maybe a safer harbor?
Let's hear it. What are the headwinds?
Well, the big one is an economic recession. Pretty straightforward.
Yeah, when the economy tanks, businesses cut back.
Yeah.
Especially on things they see as maybe non-essential right now.
Exactly. Those monthly SaaS subscriptions. Especially for smaller businesses feeling the pinch, those might be among the first cuts to save cash.
Like everyone canceling Netflix and Hulu when money gets tight, but on a corporate scale.
Good analogy. It hits the software providers directly. Then there's the opposite of low rates.
High interest rates. The party pooper for growth stocks.
Right. High rates make borrowing expensive, which hurts companies needing capital to grow. And crucially, like you said before, it hits their valuations. High PE software stocks, valued way out based on future potential, those get squeezed when rates go up.
Yeah, the market discounts those future earnings more heavily, makes the stock look less attractive right now. We saw that play out in, 2022 when the Feds started hiking rates aggressively. Growth stocks took a beating.
They really did. That's a perfect example. What else?
And Micky also flags tightening regulation as a potential issue.
Ah, interesting. Like,
Think new privacy laws like GDPR or similar things, or antitrust investigations looking into big tech or software dominance.
Okay, yeah. That can increase costs for compliance, or maybe restrict how companies can use data, or limit mergers.
Exactly. It just adds friction and uncertainty, potentially slowing down growth.
Yeah.
It's like the government suddenly making it way harder for your software company to operate, adding hurdles.
Gotcha. And finally,
Just a general market sentiment shift. Sometimes investors just get nervous about growth.
yeah, like a risk-off mood.
Exactly. They might prefer safer, more established value stocks over high-flying, maybe not yet profitable tech companies.
And in those times, XLK, with its mix including giants like Apple and Microsoft, companies with huge profits and more established businesses, that might hold up better.
That's the idea. It's less concentrated in those pure high-growth software plays, offering potentially a bit more stability when the market gets jittery about growth.
Okay. Wow. So lots to consider there on both sides. What's the verdict then? Where does this leave someone trying to choose?
Well, Micky's notes, I think, make it pretty clear there's no single winner here. It really depends on you.
Right. If you're looking mostly at recent performance, the momentum, and you're betting big that this AI and software boom has a lot further to run.
Then, yeah, IGV has definitely delivered the goods lately. It's riding that specific wave hard.
If you're more of a long-term player, maybe building a retirement portfolio, and you value stability and really low costs.
Then XLK, with its stronger 5-year track record and that super low expense ratio, plus its broader tech diversification, that looks pretty compelling for the long haul.
So it really boils down to your own investment goals, your time horizon, and frankly, how much volatility you're comfortable with.
Absolutely. Are you aiming for potentially higher growth, but taking on more specific sector risk with IGV? Or do you prefer maybe steadier, broader tech exposure with lower fees via XLK?
It's that classic risk-reward trade-off, isn't it?
It often is. Now, just a quick but important aside here. Remember, we're just kicking around Micky's ideas here on Sip and Talk.
Oh, yeah. Good point.
We're not investment advisors. Micky isn't either. He's just sharing his research. It's all just for, information and entertainment. Always do your own homework before investing any money.
Definitely. Do your own research. Consider your own situation. Okay, disclaimer done.
Yeah, right. So yeah, are you that short-term trader glued to the screen watching every AI development? Maybe IGV feels right.
Or are you building for decades down the road, want a core tech holding that's cheap and diversified? Maybe XLK is more your speed?
Yeah, it leads to Micky's kind of final thought provocation, doesn't it?
Yeah, what's your gut telling you about the future? Where do you think interest rates are actually headed next year? Still high, coming down.
And this AI revolution,
Yeah.
How much more fuel is really in that tank? Is it just getting started, or are we seeing peak hype?
Because honestly, how you answer those questions for yourself, that might just point you towards which of these two ETFs feels like a better fit for your portfolio right now.
Well said. Lots to think about there.
All right, that wraps up another fascinating Sip and Talk. Some really good stuff from Micky's notes again.
Yeah, definitely hope you all found those insights on XLK versus IGV valuable.
If you enjoyed this comparison, please make sure you hit that subscribe button for Sip and Talk wherever you get your podcasts. We'd love to have you back.
And hey, don't forget to check out our buddy Micky's YouTube channel. It's called Mickytolife. He's got all sorts of stuff on there. Funny memes, music, wine tasting, travel vlogs. It's quite the mix. A whole vibe, as they say.
He's a good guy, that Micky. Always brings interesting stuff to the table.
He really does. Okay, folks, thanks so much for tuning in.
We'll catch you next time, right here on Sip and Talk. Cheers.